Hello, good evening, and welcome to my weekly webinar, this one on trading techniques using my 2F trading strategy. So let's start off with the idea that basically a lot of the big moves that traders would like to capture typically occur after the formation of a market trap, a false breakout of some kind. So these setups are quite valuable from a trading perspective to wait for the trap to form. So I've developed a methodology which I call break and retrace, which identifies when a trap has been formed, has completed. So these market traps occur when traders are caught on the wrong side of the market. So usually they will form after a technical move, for example, the break of a support level or the break of a resistance level, but often they have a fundamental trigger, for example, a piece of news comes out. So essentially what we're looking for is a situation where the market has made a sudden move up or down based on either a piece of news coming out or the break of a support level or a resistance level. Once we get a sharp move like that, then we're looking for a counter move. And once that has occurred, once we've gone all the way back to the origin of the break move, the break and retrace, then we've had ourselves the formation of a trap. So this is essentially what break and retrace looks like, the market trap from the buy side, if we're going to trade the market from the long side. So essentially what happens is the market will start off at the equilibrium point, the start point, and a piece of news hits the market or the market breaks for a support level, and we get this big sharp break to the downside. Okay, so that's normal market price action. Very often after the break move to the downside, we'll get a reaction to the upside, and then typically the market will continue down after the initial reaction higher. But what I'm looking for here with this break and retrace is for the market to not retrace just a portion, a little bit of the break move and then go down. I'm looking for the market to go all the way back up to the point where the market broke from. So once we have break and retrace to the upside, we know that all of the sellers during the break move and after it are now underwater. So once we get to the origin point, this line here, we know that a trap has formed and the market is now ready to go in the upward direction. Because from a positioning standpoint, you can imagine there are lots of people who are short the market who will want to get out of their losing short positions if the market comes back down a bit. So this is essentially what drives the market higher. That's the theory. So I use break and retrace for a lot of things. This particular presentation is about a strategy, a pattern I've identified, which I call the 2F pattern. And it's basically using break and retrace methodology, but inside a trend. So the idea is we're using a 2F move to determine when a correction has ended. Okay, so during a strong trend, the market corrections are typically quite short. So let's say the market goes up for a few days in a powerful vertical movement, then we get a bit of a correction and then it goes up again. So these corrections might be 2, 3, 4 days, maybe 5 days sometimes, 5 bars. And once the correction is complete, the market starts to, the buyers come back in after the correction and they drive the market up to new high ground. So what we're looking for is to identify when has the correction ended. Now that's the job of the swing trader. Ultimately, a swing trader will be looking to trade in the direction of the last impulsive move, whether it's up or down. So waiting for a powerful move, up or down, waiting for a correction to that move, and then waiting for signs that the move that the original move is starting to resume after the correction. So that's essentially what the swing trader will be doing. So the 2F is really designed to help swing traders identify when a correction has ended and that the trend or the momentum or whatever you want to call it that occurred just before the corrective move is about to resume. And that's what we can use to make money from. So, as I say, many strong trends, both up and down, tend to see these shallow corrections. So we get, so if we go back to thinking about break and retrace, the trap, the break will take the form of pushing through, and this is a buy example, pushing through a 2-day low. And if the move is not sustained, we get the retrace to the upside within a few bars, and then the uptrend resumes. For the bearish example, we'll have first of all, we'll have a strong move down. Then we'll have a shallow correction to the upside. And then the shallow correction is kind of defined as the push through a 2-bar high. Once we have that, that's the break move of break and retrace. Then we're looking for a move to the downside, the retrace, and that tells us that the downtrend is starting to resume. So the bullish 2F pattern goes like this. Market has a nice strong up move, usually involving several so-called thrust bars to the upside. A thrust bar is basically where the close of a bar is above the previous bar's high. So when you get a thrust bar, when the market closes above the previous bar's high, usually significantly so, it tells you that on that given bar, whether it's a day or an hour or a week, on that given bar, the bulls were firmly in control of the market. So a combination of one or more thrust bars usually tells us that the bulls are in control of the market if the thrust occurs to the upside. So we're looking for a strong mover, usually involving several thrust bars. It can also be, the 2Fs can sometimes form as part of a basing process as well, but for the most part, we focus on using 2F within the context of a trend. So the break of the break and retrace setup is the breaking through of the lowest low for the last 2 bars. So you go back to the last couple of bars, you draw a line under the 2-bar low, the lowest low for the last 2 bars. And once we've broken through it, that tells us that we've made the breakout to the downside. This is the kind of hook that we need to set up the buy trade for the upside. If the market fails to sustain that break, as we expect it would do, we start to get the retrace to the upside. And then we're looking for the uptrend to resume within a few bars. So this is how the pattern looks like. So what you'll have is the market, this is the buy example, obviously. We have the market moving to the upside quite aggressively. So this could take on the form of a series of higher highs and higher lows. It could take on the form of maybe 3 consecutive up closes or 2 consecutive thrust bars to the upside. Whatever it is that you use to denote that the market is in a bullish environment, that's what we're looking for here. Okay, so if you're a swing trader, you're not looking to get in up here. You're looking to get in after a nice, healthy, corrective pullback. So number 1, we're identifying the trend or momentum as being up. Number 2, we're waiting for the correction. Now, the pattern is called the 2F, and that stands for the 2 failure. So basically the failure below the low of the last 2 bars. So what we're looking for is we draw a line under the lowest low for the last 2 bars. So once we break that line, we have a potential 2F setup. So what we're looking for, as I say, is we get a break to the downside, a retrace to the upside, and we're looking for the market to then start to resume its trend to new highs for the move. Okay, so let's see a few examples of bullish 2F. Okay, first up is a chart of Australian dollar, Aussie US weekly. Now, by the way, 2F work well on just about any time frame. I would suggest, as with all of these patterns that you'll see when I make my presentations, The longer term the time frame, the better the pattern tends to be, the more reliable it is. So you can certainly use 2F on intraday charts, but I would say that it's a lot better to be used on daily and maybe weekly charts. Okay, so what we're talking about is number one, we want to identify the trend or momentum of the market. And once we've done that, we're then looking for a corrective pullback. So in this case, what we've got is the Aussie dollar seeing a climactic sell-off here, basing out, and then seeing 1-2 consecutive thrust weeks to the upside, close above previous week's high, close above previous week's high. So 1, 2, this is a double thrust. So a nice double thrust to the upside. So that denotes strength, at least in the short term. So the short term, the buyers are in control of this market. So now what we're doing is we're saying, okay, we've got a bullish environment for the market. We're now waiting for the market to break through a 2-bar low for the break. And then once it's done that, we're looking for a sign of strength. So here's the break through the 2-bar low. So you count 1, 2. So that is the lowest low for the last 2 bars. The market breaks through it. Notice how the market snaps back above once it breaks through it. So fresh buying is coming in once the market breaks through this 2-bar low. That tells you that there is some underlying strength in this market. So the market breaks through the 2-bar low, snaps back above it, in fact closes above it in this example. So most of the time it does that, but sometimes it doesn't. And within the next couple of bars, the bull trend which is unfolding starts to resume. Look how powerful this advance is. So close above previous bar's high, close above previous bar's high, close above previous bar's high. 1, 2, 3, that's a triple thrust. Okay, so that confirms our suspicion that the market is in a bullish phase. Again, we're waiting for the pullback. And the pullback comes here. We get the push through the 2-bar low right there, 1, 2. So this is the lowest low for the last 2 bars. And yet again, the market pushes through it, but by the close of the bar, the market is significantly back above the broken support level. So again, it shows you that there is underlying demand in this market. We have a thrust to the upside, we have a little correction, the correction breaks through the 2-bar low, just as it did here, but by the end of the week, the market is significantly higher. So what follows after the bounce back is 1, 2, 3 there, 1, 2, 3 there. So again, another triple thrust in the direction of the trend. Okay, a few more examples. Obviously, this is not going to work every single time, but it's just like anything in technical analysis. Obviously, you need to use stop to protect yourself, but it can provide a very good indication. Here we have a big move to the upside. Market breaks through the 2-bar low, springs back above it, closes above it. Next bar, powerful move higher. Here, the market's in a bit of a sideways phase, breaks through the 2-bar low, snaps back above it, and before you know it, the market is accelerating higher. The market pulls back, market goes into a range. Again, the market breaks the 2-bar low here, but closes significantly above it, pushes higher. Okay, dollar yen daily chart. So this one starts off by starting an uptrend. So nice move higher here. So this puts us on the long side or the bullish side of the market. So again, what we're waiting for a nice push to a 2-bar low, which is not sustained. So we get one attempt there, which isn't followed through. There's no push through the next bar. And then we go sideways, we retest the high. Then we come back down here. This is another attempt, breaks to the downside, fresh buying comes in. By the end of the bar, the market is significantly higher. Compare this to the this one here, closes above previous close, closes in the top of the range, closes significantly above the support level. Here, the market couldn't close above the previous close. And crucially, within the next bar, the market starts to break higher. This one, the market didn't break out through the high of the bar. So within the next few bars, the market is trending higher. So that's what we want to see. We're still bullish. The market is trending higher. We're waiting for that push to the 2-bar low. It comes here, push through the 2-bar low. But again, by the end of the bar, the buyers have come back into the market and they've pushed it higher quite aggressively so, and the market then goes up for a few more days. Pullback, bounces back up again, another push to the downside, a very marginal break of a 2-bar low there, but again, the buyers come back in after that push through the 2-bar low, and before you know it, the market is making new highs for the whole trend. Another pullback here, we're still bullish, breaks through the 2-bar low, but again, by the end of the day, closes strong, and next few days for the upside. So you can see the 2F can give you a bit of a leg up in terms of market timing. Even if it's just for the next couple, 2 or 3 bars, it can give you a good idea which way the market wants to go. Okay, so I mentioned that 2F works quite well on longer term charts. Here's a monthly chart of the Australian dollar versus the Japanese yen. So the chart starts off with a kind of a pullback, quite a sharp setback, bit of a bounce, and then a kind of a retest of the low. We get this marginal push through the 2-bar low there, very marginal. And by the end of the bar, the market is quite strong. And this kicks off the uptrend. So we go up, we pull back, we're waiting for the 2-bar low, we break through the 2-bar low. Notice how the market breaks the 2-bar low, but by the end of the bar, which is a month, the market is significantly above it. So the buyers have kind of won that particular battle. Next month, the market starts to push higher again. So a nice opportunity there. So now we're starting to develop this kind of uptrend. So we're looking for again, the break through the 2-bar low, which happens there. By the end of the bar, the market closes strong. We don't buy it on the close. We're looking to buy the break to the upside, to break and retrace. Next bar it occurs, and up we go. Pullback, sideways, breaks through the 2-bar low very marginally again, a bit like here. But again, by the end of the bar, the market is strong. We wait for the breakout the next bar, up it goes. So we're still in this nice healthy uptrend. Market, we're waiting for the 2-bar low. The market breaks through the 2-bar low there. Again, by the end of the month, the market is significantly higher and gives you a nice early warning of this move which followed. So lots of opportunity there. This one is another longer term chart. This is a monthly chart of the Dow Jones Industrial Average. Just to show you that this thing can work quite well, not just on currencies, but also on stock indices and gold and oil and on other markets. So it's quite a good tool to use, one of many tools that you can use in your technical armory. So the Dow Jones formed a major low in the summer of 1982. And this major low occurred in the shape of a bullish 2F pattern, where the market broke through the 2-bar low and then saw a powerful move to the upside. So before you knew it, the market was blasting higher within this new uptrend. So as the market's doing this, we're asking ourselves the question, where do we buy this market? Same answer to the question. We're waiting for the break of the 2-bar low to tell us that a correction has started. And once that correction has started, we're looking to buy it. So in this case, the market breaks through the 2-bar low. Again, by the end of the month, closes significantly above it. So the next 3 months are to the upside. So a nice opportunity there. Bit of a pullback, bounces back up, sideways range. Again, the market breaks through the 2-bar low very marginally again. And by the end of the month, the buyers are firmly in control of this market. Closes above the previous close, closes way above the broken support level. Next month, the market starts to accelerate, and so on and so forth. All of these corrections that you can see occurred after a very marginal break of a 2-month low. So it shows you, it gives you a kind of something to look for when it comes to corrections. So you identify the trend or momentum, and you are waiting for that push to the 2-bar low. You could even try to anticipate the 2F forming by drilling down to charts of a smaller time frame. So you could be looking at the monthly chart here to say, okay, we're just breaking through the 2-month low and the trend is up. Okay, let's look at our daily charts, and that might give us a kind of a early indication that the major trend is resuming. Okay, so that's the bullish setup. So with technical analysis, it's just a question of turning the chart the other way around. What works on the upside should work on the downside too. So the bearish 2F pattern goes like this. First of all, the market suffers a sharp decline, usually involving several cross bars where the close is below the previous bar's low. This can also form as part of a topping process, but the main focus really is during a downtrend. We're looking for a trend resumption indicator. So the setup forms like this. The market breaks through the highest high for the last two bars, fails to sustain that break, then we start to get the retrace to the downside, and then we're looking for the downtrend to resume within a few bars. So here's the graphical representation of the bearish 2F. So the market swings to the downside. Now this swing to the downside, as I say, could take on the shape of lower highs and lower lows. It could be 3 consecutive closes. It could be a double thrust. It could be anything that you use to identify a bearish environment. So once we've got that as a swing trader, we're looking for an opportunity to sell the market, but only after we've broken through that red line or any color line you like, the highest high for the last two bars. So we get the break of the 2-bar high, and then we get the retrace. Remember, break and retrace. So once we've seen break and retrace to the downside like this, then we're getting ready to sell this market, looking for a continuation of this move. Okay, so let's see a few examples of the bearish 2F pattern. Okay, first up is dollar Canada weekly chart. So the chart starts off with a little bit of a sideways range, and then we get the first clue that the bears are getting control of the market right here, where the market initially does a double thrust to the downside, 1, 2, and then the market tries to push higher, but sellers come out right above, just above the 2-bar high. So you can see the market briefly pushes above this 2-bar high, 1, 2, and then the selling pressure comes in. So big selling pressure, but by the close of the week, dollar Canada is just on the low of the week, below the previous part's close. It's ready to go down. There are no more buyers in this market. So next week, the market then starts to break lower. We see this double thrust to the downside. So 1, 2 consecutive thrusts to the downside. Very often times I've noticed, just studying market price action, by the way, is the market likes to do 2 or sometimes 3 of these thrust bars in the direction of the trend before seeing a reversal. And so obviously, if you get a double thrust, it's not a bad idea to take some profits. So in this case, we have thrust, 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 thrust. Okay. So this occurs on quite a regular basis. It doesn't happen every time, obviously, but it happens enough for you to think this could be a good way to take profits. Okay, so there's your first example there, breaks down. Market sees quite a powerful rally because we've had a big decline, so kind of action and reaction, quite a normal reaction after this. Then we start to see some aggressive selling here. So this really confirms that the trend is down. Again, we're waiting for pushes through 2-bar highs, these red lines. So you'll notice that every time it pushes through these 2-bar highs, it doesn't stay above for very long. So that is typical bear market action. So again, we're looking for the market to break through the 2-bar high in a downtrend, and then we're looking for a good sign that the downtrend is resuming. Okay, drilling down now to intraday charts. This is a 240-minute chart of cable, sterling dollar, and it starts off with the market pushing up to a swing high and forming a 2F top. So what we have here is the market making the highest point. The market pulls back, it makes a lower high, which makes the swing high the 2-bar high. We push through the 2-bar high, and then sellers come out, and then we get this outside bar, and that tells you that the buying pressure has been exhausted. So now the market is in a kind of a bearish topping idea process. Now the market breaks through the 2-bar high here, but again, a bit like on this bar, the sellers come out and they push the market down through the previous bar's low, making a bearish outside bar. And before you know it, we see some aggressive selling. So not a bad signal there. Pushes through the 2-bar high, break, and retraces all the way back down. So good opportunity there. So at this point, we're pretty sure that the trend is down and we're looking for a sell opportunity. So where do we sell it? What are we waiting for? We're waiting for the push through the last 2-bar high, which happens to be here. So the market again does that marginal push through the 2-bar high. And guess what? The sellers come out after that push through the 2-bar high. And again, we get another outside bar. So the pressure is so strong to the downside that the sellers crush the buyers basically and end up with the close significantly below the previous bar's close. Next few bars, the market breaks down to new lows for the trend. Drilling down even further, this is a chart of dollar yen, a 15-minute chart this time. I mentioned obviously before that 2F works on just about any time frame, but obviously you need to take a bit of caution when it comes to the shorter term intraday charts. But just to show you a few examples of 2F for a 15-minute chart. So dollar yen starts off in a bit of a sideways move. We get this push through the red line through the 2-bar high, which is there. But next bar, the market breaks to the upside, retraces to the downside. So the buyers have been crushed. And then we get this 1, 2, 3, a triple thrust to the downside. So telling you that the bears are in control of the market. A bit of a bounce, market breaks down, and then we get this kind of consolidation. We get the push through the 2-bar high here. Next bar breaks down, so break and retrace, down it goes. Nice opportunity there to grab 10, 15 pips on the downside if you're a day trader. Market bounces up, forms a 2F top there. Another good opportunity here to hit the market, breaks down, double thrust, wait for the correction, break through the 2-bar high, but the sellers come out, it closes back underneath it. Next bar starts to break down again. So we get this kind of trapped situation here. The buyers are trapped above this red line. The market starts to go break, retrace, down. Another bounce, fails at the 2-bar high. This one's euro dollar, going back to a larger time frame, euro dollar daily chart. This one starts off with a 2F top where the market rallies. It's in a bullish situation. It makes a lower high there, which means this is a 2-bar high. So lower high means this is a 2-bar high. Market breaks through that 2-bar high, but fails to close above it. So a bit of a warning sign there for the bulls. Next bar, the market starts to break down. And we get, then we find that we are in a bearish phase with thrust closes, close below previous bar's low, close below previous bar's low, nice double thrust and a correction. So at this point, we are seriously thinking that the market is in a downtrend. Now we're looking for those 2-bar highs to think about where we're going to sell the market. So here, the market breaks through the 2-bar high, the red line, but again, the sellers come out on the break of the 2-bar high, and it closes back below the 2-bar, the red line. Next bar, we see the break to the downside, and we start to see aggressive selling. Again, another opportunity here. Breaks through the 2-bar high, sellers come out, smack the market, closes very weak, big move to the downside follows. Again, breaks through the 2-bar high, this time closes above it, next bar closes back below it, trap is formed, make it all over the trend. Another one there, breaks through the 2-bar high, next bar closes below it, trap has been sprung, and so on. Lots of opportunities there using 2F to make money on the short side of the market. Okay, so that's the examples. I hope they're kind of clear to everybody. And by the way, if you've got any questions, please hold them back until the end. I'll be very happy to answer any questions on the strategy. Okay, so how do I trade the 2F strategy? This is the buy situation. So For the buy setup, the idea would be to identify the 2F bar to the downside. So once the market has broken through that 2-bar low, the red line, then we're putting a buy stop to buy the market just above the high of the 2F bar. If we go long, we are going to place a protective stop just below the low of the 2F bar. We could use a tighter money management stop if that bar is too big, but the best place usually to put a stop is below the low of the entry bar, or below the low of the bar you're using to enter, not the entry bar necessarily. On the upside, if we're right about our trade, we'll be looking to get out of 1 unit of each of those of the 3 units that we bought at PT1, PT2, and PT3. So we're going to be placing limit orders at 3 target levels. And as the market hits our profit target levels, we're going to be raising the stop, locking in the profits as we go along. So that if the market snaps back, then we're not going to be losing any money. Also, I like to, into most of my my trading strategies and algorithm systems, I like to have a time exit, because most of the things that we're doing, these patterns that we're trying to take advantage of, the move which follows has got a very limited time span, shelf life. So we're looking to get out after so many bars in the trade. I like to normally say 2 bars, 3 bars. This particular one could be quite good, 3 to 5 bars in the trade. Okay, so what we've got here is the buy setup and how to manage the trade. So initially we get the swing to the upside, which tells us that we're bullish. Okay, so we are bullish at this stage. But we don't want to buy the market until we've seen that healthy correction, which basically unwinds the overbought situation. Okay, so swing to the upside, we're bullish, wait for that correction. And the correction for 2F is defined as making or breaking through the lowest low for the last 2 bars. So we draw a line under the 2-bar low once the correction starts. We break through that line. Now we're thinking about buying the market. We've had the break to the downside. Now what we want is the retrace to the upside. Break and retrace. So for this pattern, break and retrace is done, is formed when we get back above the high of the 2F bar. So when we get the formation of the 2F bar, on the close, we can put our buy stop for 3 units just above the high of this bar. Okay. So on the next bar, or the next 2 or 3 bars, if we can break above this blue line, then we're buying 3 units of whatever market we're talking about. So for example, if you trade foreign exchange, you could be buying 0.3 lots or 30 lots or whatever it be. The idea would be to buy, to trade a lot size, which you can divide by 3, because the idea is that if the market goes in the direction we expect it to go, we'll be selling a third here, a third there, and hopefully a third here. Okay, so I mentioned that should we get triggered on our long position, we'll be placing a stop loss just below the low of the 2F bar. So your risk is going to be this high minus this low. That's your trade risk in terms of pips or points or whatever you're using. So you buy here, you put a stop here, and you're looking for PT1, 2, and 3. So hopefully, if the trade goes in our favor and we hit the first target, we bought 3 units, we've just sold 1 at the target. So we bought 3, we sold 1, we've got 2 units left, at which point we can move the stop loss from the risk level to our entry point here. So if having hit PT1, the market then reverses and comes back to our entry point, we just get out. There's no more risk on the trade. So we've made a small amount of profit on 1 unit, but we've got out of the other 2 units for no loss. So if the market continues to go in our favor and hits the second profit objective, PT2, we then sell another unit of our original 3. So we've got 2 left, we've sold 1. So now we've got 1 unit left. We've hit PT2. We can then move the stop up to PT1. Again, if the market reverses from PT2, back to PT1. We just get out of the remaining unit we've still got left. And then we've locked in this amount of profit on our second unit. And hopefully if the trade ends well, we hit our third target and say thanks very much. Or if not, we just simply get out on the time-based exit. So let's say that time-based exit is get me out after 3 days. So after 3 days in the trade, we just take our, we just get rid of the remaining position, whether it's a profit, whether it's a loss, we don't care. We just want to be out of the trade. Okay, you may be wondering where the PT levels come from. We've got a couple of choices here. We can use multiples of the stop size, in other words, the initial trade risk. That's quite a common one to use. So let's say we're risking, I don't know, 50 pips on the trade. We could be taking our first target at 50 pips profit. PT2 could be 100 pips and PT3 could be 150 pips. So just multiples of the initial trade risk. Another way to do it would be to use a volatility measure such as the average true range, or the price bands, the highest high minus the lowest low for the last so many bars, a volatility measure, and that keeps it kind of more in sync with the market rather than a fixed points-based objective. So whatever it is you use, it's good to stay as constant as you can. I also mentioned I use time stop, so exit after so many bars. The main point here is to capture as much profit as we can while momentum is in our favor and reduce our risk as time goes on with our trailing stop. But don't forget that momentum is a very short-term concept. So the market can change with the wind. As we've seen, the market will go up for 2 or 3 days and then it reverse for 2 or 3 days, go up again for 2 or 3 days, that kind of thing. So the idea would be to use the short-term pop to the upside, momentum pop, to get out and to take our profits. Okay, again, what works well on the upside should work well on the downside. So here's the 2F sell strategy. So first things being first, we are waiting for the sell setup. So what we're doing is we are, once we've identified a downtrend or a bearish environment, we're waiting for that push through the 2-bar high. That's the 2F bar. So once we've identified the 2F bar to the upside, we put our sell stop for 3 units just below the low of the 2F bar. If we get filled on that, if we get elected on the short entry, we are short 3 units. Now again, that could be 0.3 lots, it could be 30 lots, whatever market you're doing, it should be in a size where you can chop it up into 3 different portions, with the objective of getting out a third of your positions at PT1, 2, and 3. Okay, so should we go short, we need to put a stop in to protect ourselves, because not every one of these 2F patterns is going to result in a profit. That's just the way it is. We could use a tighter money management stop if that 2F bar is particularly big. Again, if we are short, we will need to figure out where we're going to take our profits. So we calculate our PT1, PT2, and PT3 levels, and we put our limit orders in to take our profits at those levels. Once we hit our PT levels, if the trade goes the way we hope it will go, we'll be locking our profits in and reducing our risk, lowering the stop as time goes on. Again, we want to exit the trade after 3 to 5 bars and say thank you very much, hopefully. Okay, so this is what the 2F sell looks like. So the market swings to the downside. Again, this could take on the form of just a series of lower highs and lower lows, a nice typical downtrend. It could take on the form of maybe 3 consecutive closes. It could take on the form of a double thrust or a couple of bearish engulfing candlesticks. Whatever it is that you use to define a bearish environment, that's what we're going to be using as the first part of the setup. Now, we're using break and retrace methodology to get us into a sell trade. So again, what we're waiting for is the market to break through the highest high for the last 2 bars, these 2 bars. That's the highest high for the last 2 bars. we push through the 2-bar high, and it doesn't necessarily matter where we close. The point is we've broken through a 2-bar high for the first time in the sequence. If, for example, we do it on the next bar, we break again through the 2-bar high, that doesn't count. What counts is the first push through the 2-bar high. So there's the push, and then it closes here. So the sell trigger is at just below the low of the 2F pattern, which is there. So should we break through the 2F low, we go short 3 units. We put a stop above the high of the 2F bar, and we're looking for PT1, PT2, and PT3. Let's see how we manage the trade. So if the trade goes well and we don't get stopped out and the market goes in the direction that we want it to go, down, we hit the first target, we sold 3 units there, we've bought 1 unit back here. So we've taken profits on 1 of our 3 units. We can then lower the stop loss from the risk level here to the entry point here. So again, should the market bounce back from PT1 to our entry point, we just get out. We say, thank you very much. We've made a bit of money on 1 unit, but we've made no money on the other 2 units. Not a problem. We move on for the next trade, the next opportunity. If we're lucky enough and the market continues to decline, we hit our second target, PT2. Great. We buy back another unit. And again, we're going to be lowering our stop loss from the risk, from the entry point to PT1. So what we're doing here is we're locking in some more profits. So if the market then bounces from PT2 to PT1, we sell out the other 2 units, and we've made a bit of profit on those 2 units as well. And then hopefully the market breaks down to PT3, we close it out, thanks very much, or we just get out on the time-based exit. Again, just to reiterate, PT levels can be based on multiples of the stop size, the initial trade risk. So again, if we're risking 50 pips on the trade, we're looking to get out maybe at 50 pips on PT1, 100 pips on PT2, and 150 pips on PT3. You can use whatever ratios you like. Obviously, it's good to go back over some examples, look at some historical charts, and find out what really works for the markets that you're following. But just as a rule of thumb, 100%, 1x, 1 times your trade risk at PT1, 2 times at PT2, and so on. Again, we can also use volatility measure, ATR. So we might use, for example, 0.6 times the ATR or 2 times the ATR, and that will change on a daily basis. It's just a measure of volatility. Okay. So just to summarize on the pattern itself, on the 2F setup, 2F patterns often form during these strong trends, both up and down. So what you're looking for from a swing trading perspective is you're looking to identify a 2F pattern, break to the downside in a bull market through the lowest low of the last 2 bars, the break to the downside, and we're looking then for the retrace to the upside, which takes out the high of that 2F bar. So just think break and retrace, but in the direction of the trend, if we're using the 2F as a trend continuation indicator or tool. 2Fs can form as part of a basing or a topping process as well. As I've shown you on a couple of examples, we have a couple of good 2F tops and 2F bottoms. But the main focus of this presentation really is to try to use the 2F in terms of trend continuation. So identify the trend or momentum, wait for the 2F, and then just go with the breakout, because you're assuming that once the 2F pattern has been done, we have a trap formation, which gives you a clue that the trend is very likely to continue. So rather than jumping in and waiting to just buying because the market has shot up or collapsed, selling because the market has collapsed, we're waiting for that correction. To get the correction, once we've had the correction, we know that the market is no longer overbought. In fact, I like to use the term underbought in a bull market. So the market swings to the upside, it's overbought. corrects to the downside, it's now underbought and ready to go up again. So just look for those underbought situations where the market has broken through a 2-bar low in a bullish environment. So the market is now underbought, ready to go again, but only once we've had that trigger to the upside. So the disciplined trader can benefit from waiting for the setup to occur before jumping in and making a trade in the direction of the trend. As I mentioned on a couple of occasions, the 2F is valid on all time frames and markets, although I'd say it's better to be used on daily charts and maybe weekly charts. But it's you'll see them all over the place when you start to look at charts. You'll see that the 2F pattern occurs just before some pretty good moves in the direction of the trend. Okay, so that pretty much sums up the presentation. I hope it all made sense. And if anyone's got any questions, be very happy to answer some of your questions. Nothing springs to mind just yet. Nothing springs to mind just yet. Okay, not a problem. I'm sure once you've digested it, you may have some questions over the next day or 2 or 3. Once you've looked at some of the markets and you might identify 2F, you might wonder whether the 2F pattern is valid there. Be very happy to answer any of your questions on the subject matter. Obviously, feel free to contact your CFI. There we go. Feel free to contact your CFI contact. Thank you very much for attending, everybody, and I look forward to presenting to you again. Thanks very much, and happy trading.